Charlene is in conversation with the management of Arvind. Let's get across.
Existing shareholders of Arvind Limited. The advantage is that they become independent. They have many more opportunities of raising more financial options, of raising resources for organic or inorganic kind of growth. And there is a much higher focus because they are quite independent and away from a conglomerate.
Arvind Fashion last year had, you got in a private equity player. Do we see more private equity players coming in, going ahead? And also for Anup Engineering, you do not, your cash, you don't have any debt on your book. Going ahead, do we see you picking up any kind of debt to fund growth for this business?
See, all options are open. As far as Arvind Fashions is concerned, it is one of the lowest debt equity ratios. We will be generating reasonably good free cash flows, and our next year's all growth requirements, financial growth, the kind of capital which we require, will be more than funded by our internal accruals. Now, this is all for organic growth. If something inorganic is being done, we'll explore all possibilities to see as to how those things can be funded.
Okay. Also, going ahead, what are your expansion plans for your fashion business? Are you looking at bringing more global players? Because for some time you haven't brought any global players into the market.
I think we are one of the largest set of global players in this platform. And I think I heard Kulin saying that we have many businesses which has immense potential for growth. And they are already in place. So I think the most important agenda before the entire fashion brands and fashion business is to take all these businesses to a logical kind of size and growth trajectory in the near future.
So your ROCE for your fashions business is, not too high. What is the reason behind that, and do we see that improving going ahead?
Absolutely, as we have mentioned a number of times, that if you really look at power brands, which are established brands, their ROCE, their EBITDA, and their growth is, I think, amongst the best in the industry. Then there are growth brands. Means any brand, when you invest in a new brand, it takes a while for a brand to reach size and kind of brand salience to become achieve the financial numbers. So that's exactly what is happening. And because we have a very large portfolio of growth and new brands, it is taking these numbers are reflective of those. But in the coming years, all these, as I was just mentioning in my opening remarks, that I think we expect to exit this year with all positive EBITDAs of even the new brands. So year in, year out, I think you will see improvement in our EBITDA margins. Our growth is very healthy, and this will automatically result into much improved ROCE.